This is a really good piece written by a research team. It's called Duration Bias in Price Range Forecasts. Tony, do you think the shorter you go or the longer you go, your forecasts will be more accurate?
The longer you go or the shorter you go, I'm going to say shorter.
Yes, of course. The only thing it really can be is in a shorter period of time, all our numbers are always going to be more accurate. If you go out longer, it's going to be, there's a lot more stuff that can happen. But how big is the difference between long and short term? Like, how easy is it to predict something that's a year out versus something that's a month out? Let's go to the first slide. Expected price range can give investors an idea of where assets price will most likely end up after a certain period of time, based on the sentiment of the market. Expected range, or implied volatility, can be calculated over any time frame, but estimates may capture future moves better over certain time frames compared to others. So we're going to test how well the VIX estimate of expected range forecast price movements over different time periods. Like Tony just said, shorter is going to be more accurate. Let's go to the next slide. So we looked at 25 years worth of data for this study. 25 years. We used the IVX estimate for the expected range given by range equals SPY price plus or minus SPY price plus, times VIX times the calendar days plus 365. If you can figure that out, Godspeed. We calculated the rolling expected range for the SPY over the following timeframes: 10 days, 30 days, 60 days, 100 days, 180, 240, and 365 days. And we determined how often the price of a SPY remained within its expected range by the end of a given time frame.
Okay,
you want to take a rough guess? 10, 30, 60 days. How often do you think the SPY stayed within its range, Tony? We're not holding you to this.
I know. I mean, 30 days.
No. How often? No, percentage.
I think that's going to have the most occurrences.
No. Percentage. We're looking for a percentage, sir. A number with a percentage next to it.
For all of these, I have no idea. But obviously, the further out you go, it's probably going to be closer to a 2 standard deviation.
All right, let's go to the the next slide. Here you go. So the expected range estimate captured the overwhelming majority of future price movements for forecasts between 10 and 100 days. Remembering that the VIX is derived from 30-day options and annualized. We always use 30-day for everything. So 10 days, 81.5%. 30 days, 83.6%. 60 days, 83.8%. 100 days, 83.4%. Now you know kind of why we stay in that 45-day range, because our numbers are pretty damn good. Between 83.6 and 83.8, that's pretty good. When you get out over 100 days, it drops back to 81, 240 days, 75, and 365 days, 67%. Now, to be fair, those numbers are still pretty damn good.
Those numbers are great, and I would have thought they would have been a little bit lower. But when you think about it, the pricing model, it's going to be wrapped around a standard deviation, which is at 68%. So I should have thought about it a lot better. I underestimated how good it is.
So this is why we say the markets, when you trade in efficient markets, this is why they're so damn good.
Yeah, it's perfectly priced. So what are you going to do about it? Meaning, what strategy are you going to use? Yep.
Yeah, they're perfectly priced. So as you can see here, most for everything we do, we're at about that 83%, 84% range, 83% range. Pretty good.
Yeah.
Let's go to the next slide. So the estimates captured fewer occurrences for longer term forecasts. So observing that the market, of course, because you have a lot more occurrences that are 10 days than you have that are 365 days. Observing that the market's annual outlook was only accurate 67% of the time. And you can see here, we put this up here so you can so we plotted it. So it looks kind of cool. All right, let's go to the next slide. Same numbers we just showed you. John, next slide. Of the time frames tested, the IVX, which is the VIX style implied volatility approximation for the annual expected range, captured the smallest proportion of future price moves. 84% of the moves outside of the annual expected range reached the upper end of the bound. The upper bound of the range, I'm sorry. So this is crazy to me. That So 83 to 84% of the time, the prediction was right. But of the ones that broke, of that 16% or 17% that broke outside, 84% of those were to the upper bound. Meaning we've been in a bull market, so everything's been to the upside.
Yep.
During those upside breaches, this price of the SPY ended the year about 6.2% higher than the upper estimate. So when it broke through the upside, we continued to go a lot higher. There's a couple rules of thumb on this page. One, whenever you're asked a question about anything in math, if anybody ever asked you about any average ever, teach your kids this because they'll never forget this. Always say 84%.
That's crazy. You know it's true too.
It's the craziest thing I've learned about statistics. When in doubt, if you're looking at a multiple choice test and one of the answers is 84, just take it. So this
Run with it?
Run with it. This brings me back to a crazy story. When I got out of college, I was taking I got a job on Wall Street and with Drexel Burnham. And the first thing they did for all the new recruits, they had like maybe 25 or 30 of us that they hired right out of school. They put us in a room and we had to take all the standardized tests for Series 7, all the tests that you could work at a brokerage firm. One of the tests was the futures was the futures test. It was called a Series 3. And they had somebody come in and help us with, all these. None of us had ever knew what a future was. And so they said, and I remember this like it was yesterday, because this is like 1980. And they go, if you ever see a multiple choice question and there's an 84 on there, just pick it. I never understood for the next.
And you never understood. You never forgot it. I
never forgot it because it's the only time. Because one of the first question was
the only one you got correct on the test, right?
No, I got everything correct on the test. But one of the questions I saw was said something like a lumber contract. It had something to do with lumber. And it was on a lumber contract. If such and such this, and one of the answers it was like C was 84. I go 84, done, and it was right. And so my answer forever is if you ever see 84 as a choice, just say 84. If somebody says pick a number between 1 and 100, if you don't say 33, then say 84.
Why? What's 33?
If you ask people to pick a number between 1 and 100, like a crazy statistic that most people pick either 33 or 37.
Really?
Yes, it's a crazy thing. So like when you go and you see these like your girl, Teresa Caputo, right? She says, I'm thinking
my girl, like we have an intimate relationship. Sure, go ahead. We're family members or something like that. Sure, go ahead.
You and your girl. So she says, hey, she's doing a speech or she's giving a show and you're in the crowd and she says, hey, she looks over at you, she says, hey, little Italian boy.
Oh, now she's a little bit of Eddie Murphy, 1984 or something like that.
Exactly. Go ahead. Little Italian boy. You just saw Rocky. Pick a number between 0 and 100. Okay, just pick any number between 0 and 100. And in one hand, she's got 33. The other hand, she's got 37. And that's all she's got. And then you're going to say, I don't know, 37. She's going to go. And you're going to go, how'd you do that? You read my mind.
No, I don't think so. I think you're 100% wrong, but
whatever. Do me a favor tonight.
I will test it out on people today.
Test it out on your son tonight. Say,
I'm going to test it out on my wife, my son, the construction
Here, make it easier. Make it easier. Just write down 37, okay? And then tell your son to pick a number between 0 and 50, and he'll pick 37.
Okay. How about this? I'm going to put 33 in one pocket and 37 in the other pocket, so I got everything covered.
Okay. He's probably going to pick 37.
Okay.
Now getting back to this.
You know, I was born on 33rd Street.
There you go. I'm not surprised. During these upside breaches, the prices by end of the year about 6.2% higher than the upper estimate. So when they broke out to the upside, kept going to the upside. Here's the takeaways. The expected range estimates give investors an idea of where an asset's price is most likely to fall by the end of a given time frame. For most of the stuff we do, we're right. I mean, it's the estimates are right about 84% of the time. However, commonly used estimates usually or generally capture fewer price movements for longer term forecasts compared to shorter term ones, but they're still right 67% of the time, and that's before the premium that you collect. And the estimates tend to underestimate the amount of annual upside growth in the market by 6.2% on average. But that, remember, the last 25 years, we've pretty much been in a bull market.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.